Okay, so good morning. For today, I have different things to discuss. We have the exercise of the case study at the cashew plant that I'd like to discuss the solution of with you. I'd like to start with that in a minute. And then I'd like to continue where we left off with the financial analysis sessions. So today I'd like to look at some more detailed financial model that we can work with, and also provide you with another exercise to be made before the next session of next week. So let us start with the exercise. I did receive some comment, not as much as I'd hoped. Yeah, I should add. I hope you can see the screen, the text of the case study.
Yes, we can see it.
Good. So basically, I sent you this document with background information on the case study project. It's about a cashew processing factory. It's based on an actual case that I worked on some years ago. The document included some background information on the different processes taking place there, on the operating schedule, the production inputs and outputs, different wastes and waste byproducts as a percentage of the primary product input. On the energy demand, loads, consumption, a load graph over a period of 24 hours, some indications of the average and peak active and apparent power, about their current way of producing electricity, heat demand, and then some questions to be provided as part of this case study exercise. Let me check if I can easily share the first sheet that I had for today. Okay. Right. Okay. So the solution to the exercise. So what we had were 4 main questions. First one was on the electricity demand that could be met with a bioenergy production unit. Second was about the different sources of biomass feedstocks that could be made available for electricity production, and a question what type would be the most promising. Third question about the appropriate production capacity or capacity range, and fourth was about the most likely, most promising technology options for a project, this factory. So about the first one, the table that is included in the case study document showed information on the average active power, so the actual energy consumption per unit of time in kilowatts during two periods of time. First, for a period of about 17 hours during the factory operation, and another period for the remaining 7 hours, that is during factory downtime. Now, using these figures, you can calculate for the electricity consumption during production that the consumption was about 830 kilowatt hours during this period of 17 hours for operation. During off hours, the average load is roughly 4 kilowatts, and that would frankly be too small to run an energy plant. So basically, this consumption during this period can be omitted. It would be it's most likely to use a small diesel generator to produce this electricity, pretty much in the same way as it is done today. And then combining this information with the number of operating days of 250 days per year times the daily consumption, we arrive at 207,400 kilowatt hours per year that you can expect.
Bart,
Yes.
good morning. Can I have a question?
Yes, of course. Yes.
Yeah, apparent power and reactive power is the same?
No. Well, they are quite similar. Let me see if I have the graph here. In this case, the apparent power is only a little bit higher than the active power. You know, the reactive power, let's say the apparent power is based on the, let's say, the total current that is being consumed. That includes an active and a reactive component. And in this particular case, there is a cosinus phi power factor correction. So that means that where normally in a factory where you have a lot of electrical equipment, that's electrical motors particularly, you can generally see that the apparent power is a lot higher. So the apparent power in kVA is a lot higher than the active power in kilowatts. But this can be corrected by a power factor correction by adding capacitors to the factory switchboard, and that reduces the consumption of reactive power. So that means that most of the apparent power is active power. Does this answer your question, or?
The reason I put this question is because in the bill we have active power and reactive power,
Yep.
and we pay for both. So I was trying to understand if the apparent power comes into the meter of a normal industrial facility.
Yeah, it's let's say the reason for this, you know, the apparent power is a measure of the total current that is running towards the factory, and let's say this current it does provide a load on the electrical system.
So I understand the apparent power is the sum of reactive and active.
Exactly. Well, it's not the sum, but let's say it's
vectorial sum. Yeah. Okay.
Yeah. So let's say by taking measures to reduce the reactive power, you reduce the apparent power, and that reduces the let's say the load on the electrical system, and therefore a lower kVA will.
Yeah, I got it. Thank you.
Okay, thanks. Okay, so that was the first. The second point about the available biomass. We've seen that the total cashew processing is about 13 tons per day. And over 250 days per year, that comes down to 3,250 tons per year. The document defines 3 types of byproduct or waste. That is first, that's the cashew nut shell, and that is defined as about 60% of the raw nut intake. So it's 60% of 13 tons per day. That's 7.8 tons per day of cashew nut shell produced. But part of this is being consumed at present for the heating of the cashew nut shell liquid, which is used for frying the raw nuts, and for producing process steam for stewing the shell nuts. And the total consumption of shell is about 3.7 tons per day. So what is at present available is about 4.1 tons per day, or 1,025 tons per year. Of course, there might be the option that it has to be taken into consideration that the part of the shell that is currently being used for heat production could be made available if the energy system would also be producing heat in a cogeneration scheme, but that is to be looked at separately. A second type of byproduct is the cashew nut shell liquid, the CNSL, which is a liquid that comes from small cavities inside the cashew nut shell, and let's say when the shell is heated or pressed, this liquid comes out. And in this case, the shells are fried in a bath of cashew nut shell liquid, and that means that during this process, from the raw nuts, this liquid comes out, and the total quantity produced is about 11% of the raw cashew nuts being processed. So that's 11% of 13 tons per day. It's 1.43 tons per day, or 357 tons per year. Then a third stream that was defined is the so-called testa, which is a small, thin, fibrous material that surrounds the nut inside the shell. These quantities are quite small. It's less than 1% of the nut intake, so it would be less than 130 kilos per day. That's less than 33 tons per year. And part of this is already used in the heat production. Now, what was indicated for the cashew nut shell liquid is that it's now being sold at a price of about $200 per ton. Actually, the world's market prices are even a bit higher. Or at least it used to be some years ago when this study was carried out. It used to be 300 or 350, then it has to be transported, etc. So factory gate, the price was roughly $200 per ton. And let's say for biomass, for fuels, this would be a very high price, because that if this liquid would be used for energy production, then of course you have to consider the value of this material, called opportunity costs, because you don't sell it anymore. You use it internally. So this price that you would otherwise have received by selling it, you won't be receiving it anymore. So it means that it will need to be included in the financial analysis, and that means that as a fuel, well, it can be considered. You can make a calculation, but let's say from experience, I will tell you that something with such a value, say several hundreds of dollars per ton, will be too expensive to use for energy production. If you also have to include, let's say, the operation and maintenance cost and the recovery of the investment cost, then this will not be a financially attractive solution. So the CNSL for this moment we would not be considering. The second is the DESTA. That is something that is produced in very small quantities. You could consider that it's even if it's small quantities, then it could still be considered. That's true, but as we will see, the quantities needed are of a completely different order of magnitude. So even though we can bear it in mind, for example, combusting it in a combustion system, you can combine it with the cashew nut shell, for example. You can also use some of the tester that is available, but it will be much too small in quantity for being the main biomass feedstock for a system. And that more or less leaves the cashew nut shell, which is, let's say, available in quite large quantities, more than 1,000 tons per year. It's solid biomass, which there is experience in the conversion, either for combustion or for gasification, which is of course something that in real life you need to check from online sources. So that would be my assessment, that the cashew nut shell is the type of biomass to focus on. Now, for the appropriate electricity production capacity or capacity range, there's not. I think I've indicated this. There's not a very very tight and specific way of assessing this. On one hand, you have to look at a system that still has some capacity left, even above the maximum occurring load. On the one hand, just to make sure that if there are abnormal load spikes, for example, that these can still be covered by the system. On the other hand, let's say sudden load increases are more easily covered by a system if they are, let's say, a bit lower in comparison to the total system capacity. So in that sense, you would need a certain minimum capacity. Now there's also a maximum capacity, which is determined by combination of the minimum occurring loads that you want to cover with your system, and a certain minimum loading rate of your system. And let's say that is mainly set by the specifics, the characteristics of the conversion technology. Let's say for gasifiers, for example, for most systems, say a 25 to 30% is indicated usually as a minimum loading rate. For steam systems, this can be lower, but at the loss of efficiency, especially for let's say systems, steam engines, for example, the efficiency is quite constant and quite high. Capacities above, let's say, 30 to 40% of their loading rate. But if it goes down, then the efficiency goes down very rapidly. For this case, I would suggest if we set up a maximum loading rate of the system at about 80%, and the minimum loading rate at 25%. That means that the maximum loading rate in combination with the maximum occurring load gives a minimum capacity of about 93 kilowatts, and the maximum capacity is let's say based on the minimum occurring load of 25 kilowatts and minimum loading rate of 25%. It gives you a maximum capacity of about 100 kilowatts. This means that the system capacity would be somewhere between 92 and 100 kilowatts, and so the most likely system capacity you could find in this range would be the higher range. So it would be a system of 100 kilowatts. It might mean that during some of the operating hours, especially towards the end of the production period, where the load is a bit erratic, the system might not function optimally. But for most of the time, let's say from about 11 o'clock for 10:30 and later, the system would be well loaded. I'd say more than 50% of its capacity. Now, appropriate technology options. If we are looking at a system of about 100 kilowatts running on cashew nut shell, we've seen this little graph. I'm trying to see if I can. This is my arrow here. 100 kilowatts in this graph is about here. That means that it's definitely too small for a turbine system. It's gone again. It is possible to find turbines of 100 kilowatts, but they're used normally only in systems with back pressure. Let's see, for example, in the Maragra sugar factory, they have small back pressure turbines that directly drive some of the cane crushers. But that is, let's say, for a standalone power plant, that is highly unlikely. We do see that the steam engine system is within the correct range, and we see that small gasifier, say fixed bed gasifier, is in the appropriate range. We see that scale-wise, it's within range of the anaerobic digestion technology, but let's say the cashew nut shell being a let's say a dry solid biomass matter is not suitable for anaerobic digestion. So that is a technology that is not appropriate in this particular case. I would say choosing between the steam engine and a gasifier would be possible in this case. Now, looking at the two options, just to check if for both the systems there will be sufficient quantities of biomass available. For a steam engine of 100 kilowatts, you can find an efficiency of roughly 5%. That comes from this graph. If you look at let's say the 100 kilowatts for steam engine, your year, say between 5 and 6%. And if you load it at roughly 50% on average of its rated load, then you may get a very small reduction. So let's say the efficiency, the overall efficiency would be in the order of let's say 5%. Now for a gasifier at 100 kilowatts, you might get, let's say, roughly 17, maybe 18% at most in terms of efficiency. But let's say running it at 50% load means that you reduce the maximum efficiency with about 25%. So let's say the eventual efficiency of the system would be the 75% times the 17% here, and then you get roughly 13% of efficiency. Now we know the net calorific value of the cashew nut shell. We know the amount of electricity that we need to produce. So for the steam system, we would need about 3.2 tons of cashew nut shell per day. And for a gasification option, because of its higher efficiency, you need much smaller quantities. It would be about 1.2 tons per day. Now, for both the options, the amount of fuel available is sufficient. But it must be said that for the steam engine, it's a bit tight. So let's say we have, so what quantities did we have available? We have 4.1 tons per day available, and that means that if we need 3.2 tons per day, that means that we'd be using roughly 80% of the available quantity, and that if there's for some reason or another there would be a higher consumption, that means that there is a higher risk of running out of shell than with gasification option, because it consumes only let's say less than 30% of the available shell. Then again, if it's possible for both, then the final decision on which technology to choose would have to be made on the grounds of let's say financial assessment, say looking at the investment costs, the operation and maintenance costs of both systems, and to some extent look at technology complexity and say potential risk, say robustness of systems. So those elements would have to be considered when making the final decision between the two technologies. So that is the solution of this case. I don't know if there's any questions. Is everything clear? Or again, if you would like to have more information, or let's say if there's anything unclear, you can always drop me a line by email, and I'll respond to you directly as well. That's it. Okay, so if there's no more questions, then let's proceed with the other part of the presentation. Okay, so last Friday, we've started some sessions. Let's say our session on the financial modeling. It's a financial analysis, financial modeling. Today, I'd like to briefly look back on what we've done during that session. Have a quick recap of the things that we discussed, and then start looking at a little more sophisticated financial model that could actually be used for project assessments. It's a model that is based on methodology which is presented by a manual from UNIDO, and UNIDO has since then also used this methodology in developing their own computerized financial model. But it's possible using this methodology to have and work with an Excel-based model. I don't know if everyone is equally experienced in using Excel. I find it's a skill that is very handy when you work on modeling, either technical or financial modeling, and especially when using existing models. Then I think it's probably the most widely used and easiest program software to work in. Anyway, starting the recapitulation, what we saw last Friday, previous section, we looked at, let's say, cash flows, so based on investments and annual costs and annual revenues, benefits, and we defined, let's say, a net cash flow in every year, which equals the total cash inflow minus the total cash outflow. Now that was just the net cash flow. Quite quickly we looked at options for discounting, then being the way for determining the present value of cash flows in the future, because we had established that the value of sums of money in the future is actually a bit lower than the value of the same amounts of money at today's value, and this can be calculated. This value, this present value of future sums of money can calculate by applying the discount rate. So let's say the discounted cash flow, the DCF of a certain year, can be calculated from the net cash flow in that year, divided by, say, this discount factor, which is applied, let's say, several times depending on the number of years you look into the future. And you get this formula that you see here. It's a general formula for discounted cash flows. We had a little poll, as you remembered. I asked you the question whether you prefer to have, let's say, $100 today, or let's say another payment a year from now, whether it was $100, $110, $120, $130, $140. This is the outcome. So you see that when asked whether you prefer to have $100 today or $100 in the future, 37% said, well, I'd prefer to have it in the future, and 63% said, well, I'd rather have today. For 110, it was about 50-50. 120, you saw that a majority of people started to look that it's interesting to have a higher amount in the future, and this percentage gradually increased when the future sums increased. Now the interesting thing we can learn from this exercise, from this poll, that we can calculate on this basis an indicative value of the discount rate for this particular case. So let's say this loan and this $100. You could say that, you know, in the first case, you'd have $100 today or $100 in the future. So there's no increase in the value of this in the total sum between now and that 1 year. So that's a 0% increase, and 30% of the people prefer to have that. So you could say that for this 37% of the participants in the poll, they would rather have this sum in the future. Now, looking at the $110, which is 10% more than the sum today, you could say that 50% prefer to have it in the future, but of this 50%, there's already 37% that would have liked the 100%, the $100 in a year from now. So you subtract this 37% from the 50% to know the number of people that would go for the 10% higher amount in the future. And the same you do for the other amounts. It's 20% increase. So let's say from $100 today to $120 in a year from now. You have 57%, out of which 50% you distract because they would already have settled for either 100 or 110, etc., etc. So you weigh actually the percentual increases of this initial sum of $100, and for each of the increases you apply a weight to, let's say, depending on the number of people that prefer to have it in the future. Now the average you can calculate here is 21%. So it means that for this, for our group of people in this particular case, you could apply a discount rate of 21%, and that is, you know, that's not a very strange number. If you see that discount rates would usually vary somewhere between just below 10% and maybe a bit above 20%. I don't know if there's any questions or remarks on this exercise. Again, if you want to get back at it in a later stage, please don't hesitate to ask by email. I can try to explain it a bit further. Okay, so we've been looking at the discounted cash flows. Now then we can define a total net present value of all the cash flows in a project period. And for that you sum up all of the discounted cash flows from each year, and then you basically apply this general formula for the net present value, the NPV. So that is one important indicator, because it indicates what amount of money you can expect to make from a certain investment capital. Let's say if you have $1,000 to invest, and you have an NPV for a project of let's say $200, then that means that using this $1,000 investment capital, you can expect, with this project, you can say that it can be used for creating $200 of additional value. You can compare it with, let's say, other investment opportunities. For example, you can compare it to a certain a benchmark in a country or a sector. And the benchmark could be, for example, the discount rate in combination with the internal rate of return, because that is the second indicator that we've looked at. The internal rate of return being the discount rate R, at which the NPV is exactly 0. So it means that that would be sort of the point where you find that at this discount rate, your present value of your investment is 0. So that would be sort of a cutoff rate. Now, what we're seeing looking at these indicators is that when you increase your investment costs, or you increase the annual operating costs in your project, that means that your NPV and your IRR decrease. It means that the overall profitability of the project goes down. We see if we decrease the investment costs, so lower investment costs, or lower annual operating costs, or higher annual revenues, you get a better profitability of your project. And it means that you have a higher NPV and a higher internal rate of return. And we've seen that a higher discount rate results in a higher a lower net present value, but it does not affect the internal rate of return. So the internal rate of return is not dependent on the discount rate. It's something that we've looked at during some exercises. Now we've been looking at this simplified financial model, looking at the different inputs and calculation tables. I will very briefly show them. we had the investment cost table, and looking at, of course, the initial investment in year 0, as shown here. But it can also define investments in later years, for example, for replacing equipment. We usually also include financial costs, so interests on loans that you may have to pay before you can actually start working in your project. We see that as an investment. We have defined tables for the operating costs and the revenues. We see here that the costs in different categories are defined as being constant, but there can be variations in actual projects, because, for example, for, let's say, slow startup of your system, it could be because of, let's say, growing demand for your energy, for example, for increasing numbers of customers connected to a mini grid. It could be decreasing over time because of reductions of the capacity of your solar panels. So these are all optional in later stage, and that might affect your cost. Same goes for revenues. Here we see revenues from 2 different sources. There could be more sources of revenue, and here they are represented as being constant. Here also there can be variations through time. Now we have defined both the investment costs, the operating costs, and the revenues. We can start looking at the cash flows, discounted cash flows, which are used for calculating the indicators, net present value and the internal rate of return. We've looked at financing from equity, so that's basically capital that is being invested by an investor from his own funds. It can be subsidies paid by a grant maker. It can be loans, either, say, long-term loans or short-term loans, and then you define, let's say, the total disbursements, define the total repayments, the total interests that you pay on these loans. With this information, you can set up a financial planning table showing the different inflows of funds from, for example, your loans and your equity and your subsidies, but also in later years the inflow from your sales of products, of energy, for example. It gives you a total inflow of funds. And then on the bottom part, you look at all the outflows of funds, whether that is investments that you make or your operating costs, interests that you have to pay, your repayments of loans, your taxes, any payment that you make to the investor, and that means that you have a total cash outflow, and you have to make sure that your inflow is sufficient to cover your outflow, because otherwise you have a negative cash flow, and that needs to be covered by financing means. You can deduct from all this information. You can deduct the profit and loss account, starting from your income and your operating costs. You get your earnings before interest, tax, depreciation, and amortization. Take out depreciation of the capital goods, so let's say the reduction of value over time of your equipment, and gets at the earnings before interest and tax. You reduce the financial costs, the interest, you get the gross profit, or the earnings before tax, and then you calculate on the basis of the tax rate, calculate how much tax is owed, and you get the net profit, the net income after tax. It's of course throughout the project period. And finally, we looked at a table where we calculated the so-called return on investments. So that is from the point of view of the investor, who in this particular case has invested $100,000, and he gets let's say annual cash inflows, positive cash flows, and let's say from all of these cash flows, you can calculate what is the actual net present value of the amount of money that he invested. And you can calculate the return on equity, which is basically the internal rate of return of his invested capital. Right, and then finally the total production costs that can be calculated if you know the depreciation costs and the financial costs. You can for each year calculate what are the total production costs, and if you know the quantities of product for electricity, for example, that you produced, you can calculate the average per unit production cost for each year. That can vary in time. Sorry, because the financial cost particularly can vary throughout time. Now I'd like to go through this more detailed model using the same inputs that we used for the simple model. Basically, what we saw was we had certain investment costs. I'll start from the bottom, covering, let's say, the purchase of land, buildings, equipment, the transportation of equipment, and the installation of the whole system. We can apply a certain depreciation period, saying that counting on the equipment and the overall assets to use them over a standard period of 10 years in this case. You can say that every year using this equipment for these assets, the value of this equipment and buildings reduces with 1/10 of its original value. This means that the total value of everything will slowly decrease over time, and that is included in the calculation of the production costs, as well as for the calculation of the taxes that are owed to the government. We've seen the different operating costs. We've seen the different sources of revenue, and we've defined some parameters, some financial parameters: 15% discount rate, 20% tax rate, and we'll look at the contingencies rate for the investment costs later on. Now, for this more detailed model, we have, let's say, somewhat larger tables and some additional features that can be included in the analysis. On one hand, we have these different categories which can each contain different items. So in this first column, you would usually put the different you would define the different assets, say investments, categories, investments, the types of investment in the project, whether that's, let's say, land, buildings, equipment, transport, and installation. In the second column, you would put the associated costs. So it would be $10,000 for land, $20,000 for buildings, etc. As defined in the inputs table. In the third column, you would put the expected lifetime of the asset. In the case of buildings and equipment, that would be, let's say, the 10 years that we gave it. You can also have a shorter lifetime or longer lifetime, and that would mean that in the case of say a longer lifetime, it would mean that in the end there might be a residual value after the project. So let's say in year 11, as it is defined here, you would have a residual value of your asset. If you have a shorter period, then it would mean that somewhere along the way you would have to make another investment in replacing this equipment, and so that means that you're faced with a reinvestment. But it will also eventually have a consequence for the depreciation, the annual depreciation of the asset. There's a column for where you can define in which year you make the investment. Or if you don't define it, then it's automatically in year 0. And you see that in the first column. This is the economic lifetime, where you can actually define a different number if you're allowed to depreciate at a different rate than what the technical lifetime of the equipment as defined. And finally, you have a possibility of indexing, meaning that if you want to work with inflation, for example, then it might mean that the costs of assets when they need to be replaced over time will increase. So in this table, you can indicate a percentage of increase. And then there's a let's say a place where you can define a certain contingencies rate, meaning that the total investment costs are increased by this percentage, just to make sure that you don't run out of funds. It's sort of a let's say it defines a certain amount of funds available for covering unforeseen costs. And that is usually let's say 5 or 10%, depending on the level of precision at which the investment costs are being defined. If you have a high level of precision, then you can have then you can expect fewer unforeseen costs, and then your contingency budget can be lower than when you work with let's say crude estimates. Now in the same sheet, you can calculate the depreciation. That means that, let's say, for each year in a project and for each of the assets, you can calculate how much the value of that asset decreases during that year, and then you can calculate the total depreciation, which is then used further on in the model. Now, second sheet is used for calculating the the operating and the production costs. Here again, you have a first column with different categories and descriptions of cost items. You have a second column where you define the unit price of the cost item. Then a third column where you define the number of units of, let's say, the physical units of that category. And here again, you can define a certain price index. If you expect the prices to increase over time, say more or less than the average inflation rates, then you can define it here. It's important to know that these cost categories are something that need to be put into the model. It's difficult to link them from your input sheet, so that the data is automatically filled into the calculation sheet. Same goes for, let's say, overhead costs and the marketing costs. On the other hand, the depreciation and financial costs are automatically calculated from the tables later on in the spreadsheet. And then finally, for each of the years, you can indicate your production outputs as a percentage of the production capacity. So, for example, as indicated, if you expect that the amount of electricity that you produce and sell during the project period, when it increases from, let's say, maybe from 50% in the first year, and then increasing with 5% per year from then on, then you can define this 50%, 55, 60, 65%, or at a different pace. At the same time, you can expect for, let's say, large power plants in the first years to produce, let's say, less electricity in the first year, because it's still in a sort of startup phase, and maybe faced with, let's say, initial small technical problems, teething problems. Then you look at the revenues, defining the different sources, different categories, defining the number of units that you produce as a capacity, and that is automatically changed by the percentage capacity utilization defined in the previous sheet here in the top. You define the unit price of the product, and it automatically calculates the total income from sales. And here also you can define an index that will increase or decrease the income depending on expected price changes. Now, financing, this table is quite similar to what we saw before. We have the option of defining different investors. You have your option for defining subsidy for different long-term loans for overdraft. You can define here the total quantity, the total amount that is disbursed, and the number of years of disbursement, the year of the disbursement, and the number of years of repayments, the interest level, and that will automatically calculate in this table the different payments, repayments, and interest. Then the table for financial planning, again similar to what we saw in the simple model. We have the total inflow of funds from, let's say, from financing, so your equity including subsidies, your long-term and short-term loans. In later years, you look at the income from operations, so your sales. You may even define other income if that is relevant. And you look at your cash outflow. Well, let's say the investment costs in your projects. In this case, it's all of the investment is done in year 0. You look at the operating costs, the marketing costs, and so the tax that is owed, which is calculated in a later stage. Financial costs, interests, your loan repayments, as defined in the financing sheet, and any dividends that are paid to the investors. So that means that you, in the end, arrive at a certain cash balance, and then together with the cash that you might already have in the project, it means that you get increases, maybe incidental decreases when you operate at a loss. But in general, you would see for a financially healthy project, you would see a gradual increase in the cash balance. Then we start looking at the indicators, the financial indicators, so defining the cash flows, discounting the net cash flows, and calculating the net present value and the internal rate of return, of course using the discount rates that was defined as part of the input parameters. This is again all done automatically. So if you make any small changes to the input sheet, and you automatically recalculate the financial parameters. So one of the main strength of using this type of financial model. At the same time, with the same methodology, calculating the return on investments for each of the investors that may have invested a different amount of equity. You calculate the net cash flow, the discounted cash flow. You sum them all up to arrive at a net present value and an internal rate of return on equity. The profit loss account for each of the years calculated similar to the simple model. Starting from total income, less variable costs, less fixed costs, you arrive at the earnings before interest, tax, depreciation, amortization, and then to the earnings before interest and tax, and you deduct the interest paid, then you get the gross profit. Then you calculate using the tax rate. You calculate the tax if there was a profit, and you deduct that from your gross profit to arrive at the net profits. And then you may choose to have sums of money if there's large quantities of cash surplus. You may choose to pay that to the investor in the form of a dividend. That means that it's the total cash available in the project reduces, and the investor gets a return on this invested capital. Over here, as indicated, you have the tax rate, which is defined in the input sheet. and under certain conditions, you may also get, say, a certain tax holiday if let's say, the government has such a facility to promote investments in, for example, renewable energy or other types of projects that they find important for the national economy. And they may grant certain periods in which a project does not have to pay taxes, and call that a tax holiday. You can define that if that's indeed the case. This model also features a projected balance sheet where you can follow the development of the balance of the projects as if it were a separate company. We'll look at that at a later stage if time allows in one of the future sessions. And that is more or less what I wanted to present today. I would like to show you the actual model because I'd like you to use it for an exercise that I prepared as well. Let me see if I can get the model to be displayed. Okay, so this is a view of the model itself. Basically, all of the sheets are based on this, but you can here see how it all works. Basically, as indicated, the input sheet is where you define the different parameters and variables. This data links to this first sheet for investments. So let's say all of this, you can see here, it all links to the first sheet, to cells in the first sheet. That's for, let's say, the different descriptions in the different categories of investments, but also for the amounts, and also for the over here for the expected lifespan of each of the assets. You see that these are all defined over here: buildings, equipment, related costs. Same goes for the production costs. In this case, biomass. I did not define in this case with this sample data the physical quantities and the unit prices. That is something that is more common to be done when you work on actual case, and that can then be included in the different columns here. So what I did here is just to link the total cost for 1 year, and just consider it as a single unit. That means that in the model, it will be displayed at this cost. If you can remember, as I indicated, you can define here the output in this year. If I would change this to 50%, for example, then you see that the total operating cost is reduced as well. And should add that for each different project, you should carefully consider to what extent the different types of inputs actually vary along with the capacity output. So, for example, for a biomass plant, you can see a clear variation of maintenance costs, at least, and to some extent also the staff cost, and certainly the biomass cost. If you have a lower output, but for a solar plant, for example, you may have maintenance and staff costs, which are not so much related to the actual output of the plant. So, you know, for different projects, you may get different relations between the inputs for the production costs and the output of the project. What will stay the same is the administration costs, for example. Depreciation is not affected by the output. Financial costs are not affected by the output. So let's say the total production cost includes a number of fixed costs and a number of variable costs. So that's, you know, even when you don't produce at all, you will still have certain production costs. To 100%. Well, here the sales is indicated. Again, here I didn't define in the inputs table the number of physical units or the per unit price. But I chose here to present just an amount earned per year. I just said that, you know, that's just one unit. I'll show again, if we change here the output in year 1, you'll see that the outputs here are equally reduced. Your total sales at a lower output, automatically done. Indicated the possibility of indexing. So let's say if we have a 5% increase of your sales, then you will see that for this category of income, you'll get an increase of 5% per year on the sales. It's something that should be defined for each of the income categories separately. The same here with the financing sheet. You see in this particular case we have an investment of 100,000 by the project owner, the main investor. We have 100,000 of subsidies, and we have a loan of $160,000 that is used for covering not just the investment but also some costs, let's say financial costs in the construction period. And by changing, for example, the year of disbursement, you can say year 2, it's automatically shifted to the second year. I can say repayment in 6 years, it's automatically changed to 6 years. I can say the interest rate is 15%, and the interest payments are increased. These are all automated calculations. What you will always need to do is to check whether the actual conditions for the loan are reflected correctly in the table. This is good for, you know, first calculations and indicative financing mixes. But if you get to a point where you know to the last dollar you have defined, you have agreed with a bank, for example, what will be the disbursements and the repayments base, and the amounts of interest that are owed. And you can actually input these figures instead of the automated numbers. You might get some small changes in the overall cash flows. Final thing I should add is you can here choose between the type of repayment. This is called constant principal. As they say, that means that the repayment of the loan, so of the borrowed amount is constant. That depending on the amount of loan that is still outstanding, you get a certain interest payment. You can also choose for a so-called constant annuity. That means that the payment of interests and repayment together are always at the same pace. That means that in years where you pay more interest, you pay less repayments, and on the other hand, if you pay less interest, you pay more repayments. Those are two major loan repayments schedules that you can choose from. This is the table for the planning of your financing or your financial planning. As we see here right now, we may have a deficit in year 0. That means that we will have to check back into the financing table. I see that we changed the interest rate from 10% to 15%. That caused increased interests. That means that we have to, for example, increase the loan amount. Let's see, to 170,000. It means it will have a larger influx of funds that is sufficient to cover all of the costs. And as indicated, you have to make sure that you have at least a positive cash balance in the project. Otherwise, you may have to put in additional funds as an investor, and you know that's possible, but it increases the total invested capital, and that is something that you usually want to avoid as an investor. This table is also automatically generated apart from these other incomes. We see here that there's, for example, one in the category of other income that is quite typical in the final year. If there's any leftover value in the project that would be sold afterwards, then that ends up here. In this case, that's the selling of the land. For example, land is not something that is depreciated. So after the project ends, you can, in principle, sell the land again with or without an increased price. If you would, for example, add a certain index, then that means that the value of the land could increase. Then the calculation of the returns, both the project returns, so the net present value and the internal rate of return are calculated, as well as the return on investments for each of the investors that may have chosen to invest in the project. They all use a certain discount rate that may vary. I should add. So let's say some investors may look at a project with a different view of risk, for example. It means that some investors might say that their discount rate for the investments might be higher or lower than the average that we use. That's why they can be defined independently. By default, they are all set at the general discount rate. You can easily change that by setting it to 12%, for example. What is interesting, especially from this table, let's say the return on investments, is that the financing mix has a substantial effect on the return on investment for the investor. So basically, if a larger part of the project is financed by subsidies, that means that the other sources of investment, so let's say, for example, the equity and or the loans can be less. And that means that in the end, the return on investment will be higher. So, for example, right now the internal rate of return on equity is 29%. If we would say, for example, that the amount of subsidy would be higher, let's say 125,000, and the invested capital can be reduced to 75,000, then you will see that the return on investment, because of the lower amount that needs to be invested by the investor, you get a higher return on this investment. And again, these tables are automatically generated. Discount rate is defined in the main input sheet shown. The profit loss account is automatically generated apart from the tax rate. Well, the tax rate is defined in the input sheet. If there's such a thing as a tax holiday, then it can be defined here. If it's not applicable, then it's automatically set at 0. Let's say all of the numbers here are automatically generated, and the retained profit can be read from this table, the different intermediate financial figures as well. And then there's the balance table that is again generated automatically, and as you may know, a balance sheet must always be in balance. So the total assets and the total liabilities must always be equal. So what I do personally is use this table also to check on the integrity of the financial model. If there's any formulas, calculation formulas that are that have errors, and this might show up in balances in the balance sheet. But say for financial specialists, the projected balance sheet and the development in the balance of a project will give information on the way that it's financed and the value of the project to, say, the shareholder, the one putting in the equity. So that is basically how this works. As I said, it's common to start up with an input sheet. I'll show that also for the next exercise for the next session. So you can define all of the, let's say, the technical and financial inputs. Then all these sheets are generally the same. This is the basic financial model, and that each time you start a new project, you can take out all the linkages from the previous project, and once you've defined all your inputs, you can create links from here. You say this cell equals let's say the value of the transport. You look up the value of the transport here, and it automatically links. So that later on in your project, if it appears at a later stage that the transport costs are actually lower, maybe 15,000, it's automatically changed over here. It automatically changes the total investment cost, which is automatically changed throughout the financial model. And of course, the same goes for all of the different inputs. So we can start quite early on in the project by defining them using maybe first estimates of the different costs. Start linking them throughout the financial model, and once you start getting let's say more exact figures, then you can change the values in your input sheet, and you can then check on the changes in the outputs in the different sheets of the financial model. All right, so that is that. As I said, I prepared a new exercise which is related to the cashew processing factory project. I will share that. See. Let me share it again. All right, so this is what I prepared. I prepared an input sheet on this cashew factory project, defining some basic parameters. For example, the contingency rate, interest rate, discount rate, and tax rate. I defined the salary for a plant operator. I defined a diesel price. With here the factory operation parameters, so the days per year and the hours per day. The factory input, the energy demand data. It calculates the average daily and annual electricity demand, diesel consumption in the present case, the amount of cashew nut shell that is produced, and the amount that is currently being consumed, the calorific value of the material, gasifier efficiency. Defined a parasitic load of the plant, so meaning the electricity consumption of the installation itself. a number of operators needed for operating the plant. I set it at one operator. And the total diesel savings equals the amount of diesel that is presently being consumed. And I defined the different items for the investment and the lifespan of each of the assets. I defined the maintenance cost, the annual maintenance cost, as a percentage of the initial investment. So let's say for example, for a $125,000 gasifier, you would spend on average, say 5% of that amount per year on maintenance for infrastructure for buildings and this cooling plant. It's 2% of the investment per year. For a generator, it's 10%. These are a bit crude figures, but for first calculations, they can be used. And my assignment to you is to start using this model based on the inputs on the data from the input sheet. Link all of the cells in the financial model to the data in the input sheet. So basically, what you would do, for example, let's say here the powerhouse, the cost equals investments in the powerhouse. That is this one, 10,000. Automatically get 10,000 here in your input sheet. Your expected life is similar, 15 years. Your cooling pond cost is 5,000. Again, your life expectancy of the system is 15 years, etc. Then you go to your production. You could say the gasifier maintenance. You define it as, we say that it's $125 multiplied by the 5% maintenance per year. That's the annual maintenance cost. You can say, well, it's just 1 unit. In the end, you end up indeed with this maintenance cost per year. For your sales, you can say your annual diesel savings, the amount that you save equals this 80,000. The product price is $1.2 per liter. So it means that these are your annual savings. Financing, well, you can say certain financing mix. You can say that it's, for example, completely paid by one investor. Say that the returns, you may have to link this to your discount rate as defined here in the list of parameters. So I'd like to ask you to do this yourself. A document just explaining what I would like you to do and the information that you should be able to extract from the model. I will share both the pre-prepared model and the case study document, the exercise document. I will send that to you today, and then I hope you can have a look at that and send me some solutions before next week. And I hope that it will allow you to get to know a bit the different features of this model and get a little familiar with let's say what is actually in these sheets. As I indicated at the start of the session, it does require some knowledge of Excel, this particular software, which I hope you have. If there's any particular questions on that, or on the questions, the information requested as part of the exercise, then please don't hesitate to ask them by email. I'll try to get back to you as quickly as possible. I'd like to leave it at that, because we skipped the break today. I don't know if there's any questions at this point.
I see Kemal maybe has some question.
I have a question, yes. First, did you send this Excel sheet, the last one, to us, or just the first one?
I've not sent it yet. I will send it to you today.
Okay.
But sorry, but we have received some Excel sheet for the previous lesson. Can we consider this?
Well, the previous Excel sheet was the let's say the simplified model, which you can.
Yeah, but can you explain a little bit the slide where you have put different investors, and you said that they would expect different returns? I didn't really understand that part. If you can recap. Okay.
Let me see. Maybe I can better use the one with the input data.
Uh-huh.
Let me start that up again. Data. Okay, so we have this version with the input data. Then we look at the financing.
Yeah, if you go to the investors, I think you were talking about the different investors.
Yeah. So basically, in this sheet, you can define different investor. Let's say investor number one could put in, for example, $25,000. Investor number two could put in, let's say, $75,000. So you could have an investment partner, business partner that works on this. And then you have in your return sheet, you have apart from the let's say the project-based cash flow discounting, which gives an indication of the net present value and the IRR of the project as a whole. You also have the return on investment for the different investors. So you can see here you have one investor that puts in the 25,000 as we defined in the financing sheet, and we have the second investor which puts in $75,000. Now they both get their equal share of the let's say of the profit. Let's say they both investor one may get 25% of it, investor two may get 75% of it, because of he invested more. So it means that you will see that he gets 75% of the $2,000 surplus, and he gets 500 of the 2,000. Now imagine that investor number one, which is well, let's say for example the cashew factory owner. He has a large stake in this project, and he has seen different of the gasifier units operating in other factories. So his perception of the risk of this project let's say of the technical risk, might be low. Now then of course you still have the overall investment risk. So you could say that, you know, for example, normal in a country for a similar project, you could have a discount rate of, let's say, 12%. For a private investor, this could be, let's say, 15% for the owner. But for the partner, who does not particularly know this type of project, because maybe he's, you know, maybe he's a financial guy and not so much a technical guy, his perception of the risk might be higher. So he might say, well, you know, I don't know this technology, and that means that's for this investor, the discount rate may be higher. So for example, you may have a 20% a discount rate for this investor. That means that, of course, the rate of return, which is not affected by discount rate, as we saw earlier, but we will see that the net present value of the investment of this second investor is different depending on the discount rate that he chooses. So let's say if he would have the same risk perception as the first investor, so with a 15% discount rate, he would have a higher net present value of his investments than when he thinks it's a more risky project. So if he requires a 20% discount rate. So that is between investors. Another thing is, let's put this back to where it was. The return on invested capital will change with the financing mix. So let's have another look. We have this 30% internal rate of return for an investor. We're back at the situation where there's a single investor, but that is specific for this project with this financing mix. We could say, well, let's say that the investor invests everything himself. So there's no bank loans, there's no subsidies. He will have to pay for the total project himself, and the total costs are 350,000. So we say he pays for it himself. Then, and you will see that the internal rate of return on equity is the same as the internal rate of return of the project, because you know there's only one investor, so there's no difference between the project and the investor. So let's say everything that has to be invested in the project is invested by the investor, and at the same time all of the returns, let's say the net returns of the project that determine the financial indicators, go to the investor. So there's no difference in this case between the investor and the project. The project and the investor are more or less, you know, the same. Now, if you have a system where there is a subsidy, for example, 100,000 and 250,000. So we still have the same amount of funds going in to cover the investment. It means that the project still performs the same. It doesn't matter whether the money comes from an investor or from subsidies or both. For the project, it doesn't matter. It requires certain investment, and it produces a certain return. But for the investor, in this case, instead of investing 350,000, he only has to invest 250,000, because the other 100,000 comes from subsidy. that means that the investment that he has to make is lower, but the financial returns every year are the same as in the previous case. So it means that with a lower investment, he gets the same annual net returns. So that means that per invested dollar, the returns are higher because the invested dollars are less, and that means that the returns on the equity that he invested is higher than when he wouldn't have had any subsidy. So that's for subsidy. Now, if we add a loan, we see a project with an internal rate of return of 15% and return on equity of 25%. Depending on the interest rate, loan capital can actually further increase the return on equity. For example, if we decide, as we had before, to invest $100,000 by the investor, that means that we have to borrow the remainder from a bank, and we've seen that we'll need a little bit more. So let's say 170,000 from a bank, because we will also need to pay interest. Let's put the interest rate at 10% for now. We paid in 5 years, and disbursement is year 0. That means that of course interest has to be paid on this loan, so that reduces the return for the investor. At the same time, he has to invest even less. So instead of 350 if he were the only investor, or 250 if he would get a subsidy, in this case he only has to invest $100,000. Now, because the interest rate is well below the rate of return of the project, that means that the project itself generates enough net revenues to cover not only the interest costs, the financial cost of the capital, but also generates more than that, which again goes to the investor. So by using a loan, in this case with a relatively low interest rate, it means that the investor has an additional benefit from the project, even though the total returns, financial returns, will be lower because these loan costs, these interest costs have to be paid. Because his investment is so much lower, the overall effect of this, so the combination of a much lower investment with a somewhat lower annual return, results in an internal rate of return on equity, which is again higher than what it was without the other means of financing. So in this way, you can see what is the returns of a project for an investor, and you can see what different financing mixes can mean for different investors. I don't know if this makes any sense, if this answers your question.
Yeah, thank you. Yeah, it was very good. Thanks.
Okay, thank you. Okay, any other questions for today? No more questions. Once more, if there's any questions that pop up at a later stage, just drop me a line on email. I'll get back to you as quickly as possible. Like I said, I will share this model for the next case study, and I wish you a good afternoon. I hope to see you next week. Thank you.
Thank you, Bart.
Yep.
So have a nice week.
Thanks to you as well.
Thank you very much.